Do you expect another market crash this year? Today we're going to talk about the stock market forecast and the world economic outlook for 2021. Hey guys, please hit that subscribe button, that like button, share, bell button, and hit all so you get all the notifications. In today's episode, we're going to look at one of the best economic indicators out there. We're going to see a lot of charts. They're very significant for what's going on right now in the world. Right now, there's lots of uncertainty, lots of fear, and this presentation will help you to understand what's going on. After, you will have a clear overview of what's happening and maybe how you can protect yourself of this uncertainty. So let's start. Okay, first I want to talk about gold. And why is this so important? Because gold is our barometer of how healthy is the economy. It's basically a very good indicator, and basically it gets stronger when there's like all this financial stability, and it's a natural hedge against inflation. And it's the only existing money among silver because it covers all the characteristics of money. Amazing metallic duo is telling us that something is of course wrong. Here we can see that there's some kind of bull run the past year, and now we can see that it's forming a pattern, maybe a cup and handle pattern. Of course, everything below this resistance level, it could go to the downside. Now in the monthly chart, we can see here that the MACD could signal some kind of bear market. But of course, the fundamentals of the economy right now, I think this is not making lots of sense. So everything below the all-time high is basically just an opportunity, a discount to get into gold. I want just to say that gold has always been a measuring stick to measure knowledge and wealth. Sometimes in the stock market, certain companies shines just because of the price, but not because of the value. So this is translated into a time's distortion of the society. Of course, time is scarce, and of course, borrowing from the future in this debt-based economy is damaging human society's learning curve and progress. So as we discussed, everything below here is just an opportunity to basically hop on in the long bull run market. Maybe it could be as long as this one, but we just don't know yet. It will be significant, and if it continues, it will be in the long term. Then we will talk about Bitcoin. Of course, we cannot ignore Bitcoin and gold because they are right now just a store of value. And for this, I recommend you to watch the last video of gold and Bitcoin so you will understand the importance of these two assets in this context of high debt, global phenomena of currency debasement, worldwide economic shutdowns, and nation-state economic model. Just the economy is pushing people to seek shelter in other assets than currency and bonds, and Bitcoin is the king of all of them. And it's now something disrupting our banking system. Every bank tenfolds every deposit as an accounting entry, and they don't even have reserve requirements anymore, destroying all your purchasing power. All this environment, like DeFi environment, it's opening lots of business opportunities. And of course, some companies like Uber, it's basically embracing the technology and pushing forward. And of course, this will even open more doors for more job creation and basically technological development. So it's very new, it's under observation, and we just have to keep an eye on it. Until now has been a great store of value with a great value proposition of security. Humanity has reached by consensus that Bitcoin is of course money, and every economic system is based on trust. So Bitcoin of course started to pump to the upside, reaching almost the $50,000. And now it will not surprise me if we see a healthy retracement in a short to medium time frame. The correction will probably be sharper because we went to the upside very fast. And I suggest you to wait until we have reached the 21 week moving average. This is on the weekly chart. This is the monthly chart, but the weekly chart you can place the indicator that the next retracement reached that point, and maybe it's a good time to enter. This is not financial advice, of course. Decentralized money makes lots of sense. The existence of money and commerce precedes the nation-state existence, and suddenly it was accepted that governments are more competent to control the fundamentals of our economy. But circus and entertainment shifted our attention to some other place. Of course, now it's altcoin season and all things, but not everything that has a blockchain sparks. And of course, as long as the hash rate in Bitcoin, which is the process of power of the Bitcoin network, to ensure the validity of the network transaction. So as long as it's strong, it correlates with the success of the product. This means it will continue the bull run and it will be a strong decentralized platform. Now let's go to another indicator. Here we can see the volatility index called VIX. Of course, when volatility spikes up, sends us an alert of financial instability. And we can see here the period of 2008 when the Great Recession started, that it started to went to the upside until it broke this significant resistance level. And of course, we got deep into a financial crisis. And recently happened the same thing at the end of 2019. Considering that the economy has underlying problems and roots, the virus was just the drop that spilled the glass. There was a huge liquidity problem, pushing equities to a sharp decline. And then, of course, this was very significant volatility and it shook the markets and it crashed the market. Lockdown measures only proved us that they're very good at crashing economies, not preventing the virus to spread. Quantitative easing controlled the volatility, and now there is a downtrend that it seems to continue to stabilize the economy. But this is a vicious cycle because the cure is the underlying problem, and central banks can't find other options. The last resort is to debase the currency. Then we're going to talk about oil. In the 70s, when the convertibility of the dollar was cancelled, the end of the gold standard, the agreements between the United States and Saudi Arabia shaped the petrodollar economy. This agreement ensured the US dollar as a protagonist in the exchange of commodities in the international markets. Dollars, giving the United States an immense privilege to be a world reserve currency and the ability to run a deficit as long as, of course, they consume. But here back in March, we saw that oil went to basically negative territory. The price just tanked down. My perspective is that we were looking at the US dollar funeral, and now countries are pushing de-dollarization strategies like China and Russia and are going to shape a new world order. Oil fracking companies in the United States needed the price of oil to be above 50 to be profitable. These companies were highly leveraged, and with this liquidity problem, basically they put them into struggle because they needed to keep up with all their basically fixed costs. And when the pandemic started, this was of course not favorable for them, and that's why the Federal Reserve started to basically debase the currency, applying the quantitative easing program and stimulus checks and everything else. Institutions are using all kinds of tools to kick the can, trying to stabilize the economy to continue being a world reserve power. And of course, let's see how it goes. If there's low price of oil, that means that the US dollar, it's getting weaker. And of course, as countries like China and Russia are de-dollarizing, of course, this is just not good for the global financial stability. And we can see the results in the DXY, in the dollar currency index. Here we can see that there is a downtrend overall in all the years. When this problem started, there was a short spike to the upside because there was lots of demand for US dollars. And then suddenly we can see a sharp fall against. And of course, the best scenario for financial stability is that this goes sideways, right? If it tanks, well, it's just not favorable for the US economy. And of course, this world reserve currency will create a dollar shortage, and as well will not be favorable for any economy. Everyone that has United States dollars, they just will just run out of there, and now we're not prepared for that. So going sideways is just the best way to stabilize the economy. And of course, if it goes down, well, gold and all these asset classes will just go to the upside, and we will see a price increase. Of course, we can make a comparison when there was some protectionism before even the Cold War and the last century, and that creates more tensions among nation states because the surpluses, import, export, basically you punish other countries and you tax other countries. But now with this globalization, it just creates more tension among individuals and local governments. Of course, there's a global increase of taxes inside borders. Here we can see the Federal Reserve balance sheet. Of course, I think everybody heard the word unprecedented amounts of quantitative easing compared to the 2008 crisis. This has just doubled or tripled in a very short period of time. And this means that they will ease more money, they will inject more money into the economy, and they are debasing the currency and creating a huge transfer of wealth from those who save to those who spend. Because there's no currency that basically gives you purchasing power. That's why Bitcoin and gold are going up, because people want to preserve their wealth. Here we can see another interesting thing, that it's the Phillips curve, and this is basically measuring the inflation rate and the unemployment rate and how they correlate to each other. So under normal circumstances, inflation and unemployment have a stable and inverse relationship. When there is economic growth, that means that, of course, people are consuming, they're getting wealthier. Of course, inflation comes as they start to spend inside the economy, which in turn should lead to more jobs and less unemployment. But right now, this isn't the case. Something is broken. This is not working. The increase of money supply brings high levels of both inflation and unemployment, leading to stagflation. So they have to debase their currency, nation states, because they want to avoid uncomfortable restructurings by creating currency out of thin air. And these are central banks all around the world right now. If the issuance of currency were beneficial, of course, Zimbabwe, Venezuela, and Argentina would be the world economic leaders today. But of course, this is not healthy for the economy. Now I want to show you guys how the interest rates, and in a low interest rate environment, always pushes the stock market. Here we can see an S&P 500 historic chart, and here we can see in the green the federal funds rate, and we can see that every time they lower the interest rates, basically the stock market pumps, right? So this is basically correlated somehow, because when there's like a lot of when there's easy money available for companies and individuals increase their assets, they can increase their purchasing power and basically inflate the demand for asset classes, pushing the price up. There is some risk here because there is some point that the price is not showing the fundamental reality of these companies. So a lot of people are getting this cheap money, and because they have this excess money, they start to invest in the stock market. And when there's just a lot of people getting into the stock market at the same time, it just pushes up the price. And that's why this is the effect that correlates the interest rates and asset classes like the S&P 500. And here we can see another chart that is really, really interesting, which is commodities. And basically, once you start basically understanding commodities, you can have a bigger and broader picture of the economy and how the world is working out and how companies create strategies to have better margins and better incomes and better profits. And here we can see that this commodity index in historical chart, that right now we're at historic low territory. Basically, commodities have never been cheaper in the history, well, of course, in this period of time, which is very long. So we can see that making the American economy a service country, because basically offshoring American manufacturing companies and jobs has pushed down the cost of consumer goods like television, electronics, and some types of technology, electrodomestics and stuff, and has brought profitable margins as well, because if you globalize and outsource your deficiencies as a country and transfer in certain tasks, of course you will be more efficient, so you will be more profitable. And in exchange of running a deficit, of course, the United States has been already a service provider, and basically all their industry, well, not all the industry, but a significant amount of their industry has gone offshore. They're basically subcontracting manufacturing outside the USA, and basically all the industry, all the car manufacturers, a lot of factories, basically they cannot keep up with the wages in the United States. And here we can see the commodity index, how it's weighted. Basically, it's composed by many commodities like energy, crude oil, corn, soybeans. This is the grains family. The industrial metals, zinc, nickel, aluminum, precious metals, sugar, coffee, and livestock. And all of those have basically different weights. So this is more energy based, and industrial metals. Those weights shape the level of the index. The lower part is livestock, like live cattle and hogs. So basically you can see that commodities overall, they are very cheap. The strength of the dollar has pushed down the price of raw materials, and the cycle has to be reverted at some point. So a strong dollar has pushed down the price of raw materials. This is because if they have a strong dollar, basically they can push down every market they want. They can basically short all the industrial metals or any raw material, sell a more profitable product with higher margins. They can push down the energy prices, the grain prices, and now it's going to happen the opposite. There's a weak dollar ahead, and of course this will not be possible. That's why commodities will surge up with strength. Of course, we need to consider supply and demand. Now there's another chart that it's why globalization is the driver of disinflation. Basically now there's no velocity, right, in the economy. There's no significant rise in prices. There's some deflation present. All those lockdowns demonstrated not to be good at containing the spread of the virus, but very good at destroying all the economies. Why globalization is the driver of disinflation? Here we can see the CPI year-over-year change. Since the 90s, that there was like a huge amount of inflation, and the world started to globalize aggressively. And this is why basically the United States started to offshore American companies and started to collaborate all around the world in certain supply chains. For example, the fashion industry manufactures all the clothing in developing economies, lowering their fixed costs and, of course, the direct costs of production. Then those inventories are basically transferred to developed economies where there is more purchasing power, making higher profits. Another example is the car industry. Basically, all these Japanese and American companies, all those companies that were producing in the United States, now basically they are outsourcing part of their supply chain in other countries, and they just get the profits in the United States. And that's why they're very efficient and producing lots of product. And when there is efficiency, there's deflation, and that's why the learning curve. So shifting from protectionism to regional integrations like the European Union, NAFTA, Mercosur, and all those regional integrations have opened the opportunity for business to go international. And basically there's lots of supply chain innovation, low operation costs, low wages, cost of goods is deflationary. All those profits are used to short all those commodities down at the corporate discretion, increasing supply of currencies. And of course, this is creating like these equity bubbles, as I explained. So, but the most important things are going up, like education, healthcare, housing, transportation, and food, because that social well-being can only build from within the country, not hiring someone abroad, right? So these falling prices also means for the average worker, rising purchasing power for average citizens. Of course, and for businesses as well, because they need to restructure their costs, but sometimes they don't have the amount of time to restructure fast enough, and they encounter suddenly liquidity problems. And fiscal repression and the Cantillon effect, as I explained in my other videos, harms the purchasing power even more. And basically this leads to the destruction of the total economy. With this perspective, the best way to protect and grow your wealth is simple. Own commodities right now. Here we can see the ratio of commodities compared to the S&P 500, and it has never been this low territory. Basically, this is very significant. And with the possibility of supply chains and industry being brought back to America, which was in the beginning the Trump's plan, high levels of debt, deficit spending, and the never-ending currency debasement, there has never been a clearer sign that the cycle has shifted and global inflation is about to begin. That's why precious metals are considered undervalued right now. Another chart is the copper-gold ratio and the 10-year US Treasury. Here we can see two lines. On one side we can see the copper and gold ratio. This is obtained by dividing the market price of copper by the market price of gold. Copper represents the industrial activity at the moment. And the ratio had a positive correlation to the 10-year yield levels over the past 5 years. This means that if the copper-gold ratio go to the upside, basically the 10-year treasury would follow. And if it went down, of course, there was a positive correlation here. And now it looks like it's basically broken. More or less predict where the other line is going if one goes to one side or another. So yet recently, and now the copper-gold ratio went to the upside because gold went to the downside and copper to the upside. By looking at the chart, we can basically predict that soon those 10-year treasury will catch up with the ratio, giving us an idea where the 10-year treasury yield will go. And will the US treasuries play catch-up as projected by the historical copper-gold ratio? Or will stagflation continue to dampen yields? And this is very important because in the bond market, when treasuries are dumped, basically yield spikes, and we're not prepared for that. So the relationship between the copper and gold ratio and treasury yields looks broken. A declining copper-gold ratio shows a weakening economy, while a rising ratio shows a strength of the economy because copper is one of the basic raw materials that industry activity demands. What I was talking about is that in March, when this happened, they were basically dumping the bonds. And this shows how the system didn't work. For example, it went to the upside very sharply, and then it dumped very sharply. Here there was a 22% decline in a very short period of time. And this shows the financial instability and the vulnerability of the financial system as a whole. Because as I told you, when you drop treasuries, yield spikes, and this means that they have to go higher to compensate the market. But this was not happening, and now basically they're not having lots of success, the bonds. So how will nation states finance their deficit spending? And here we can see the S&P 500 price to earning ratio. The price to earning ratio measures its current share price relative to its per share earnings. That means that all the profits are compared with the price, and if the prices are too high, basically this is a negative sign. And here we can see the end of the gold standard that was basically stable, and then it broke here, and of course it signals as well the best time to enter the stock market because all the money printing. And here we can see that there is an uptrend, and we can see that different crises, like the dot-com bubble, when the price to earning ratio was too high, basically there was a stock market crash. Then the Great Recession, and now basically in this K recovery that all the asset classes are going up like crazy, we can expect a market crash ahead of us soon or later. All this money printing has and the low interest rate environment has pushed all the equities to go up, and now we expect that, of course, the stock market is overpriced and overbought, and at some point this will correct, like in the commodity business. So nation states get to stay in control of natural resources. That's why commodities are so important. If you get to control the commodities, basically you are in power. And slaves get paper and entertainment, like all of us in the history. And of course, this is important. Power shifts from time to time, and the world order is changing. So this year, this change is happening in front of our eyes, and we need to be aware of where things are going. So please subscribe to the channel. Last year we didn't get as many likes. I want you to please like the button, share, ring the bell, and place the all button so you can get all the notifications. If you find this content interesting, just please share it to the ones you think will appreciate all this knowledge. Thank you very much. This is it.